Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in. Okay, happy Thursday everybody. Fortunately, the issue that I raised at the beginning of yesterday's episode is being managed, and so there shouldn't be any disruptions to videos going forward. Thank you to everybody who expressed their concerns. Now, let's continue with today's episode. Yesterday's video was focused mostly on geopolitics and diplomatic moves, so today we will return to our regular focus on economic developments. And first up, the housing crisis and its building effects on global markets. Infrastructure and property construction have been key drivers of the Chinese economy for decades now. These engines of growth required massive resource inputs from around the world, with firms from Brazil to Western Australia benefiting from the huge Chinese appetite for raw resources. Official data show new construction starts in China have fallen more than 40% year-on-year every month since April. We knew that with the collapse in housing sales this year, that demand for many construction inputs would be hit too, even as public investment into infrastructure mitigated the pain somewhat. And now we have the numbers to demonstrate this. Chinese cement production has plunged to a 2-decade low this month, dragging global output for the material into decline. According to data provided by the World Cement Association, global cement output fell 8% year-on-year to 1.9 billion tons in the first 6 months of 2022. This international drop was driven by a 15% fall to 977 million tons in the volume of cement produced in China. The World Cement Association's chief executive said this week that the People's Republic of China drop has, quote, no comparison for decades, end quote. If China's property decline does end up to be structural and as such long-term, this decline in cement demand will be permanent. And it won't just end with this construction material. Markets for other resources, especially the steel-making ingredient iron ore, will be deeply affected. And the market knows it. Mica Metals International, a major importer of refined copper, for example, this week said that it's selling assets to survive a liquidity crisis compounded by real estate woes. China's housing crisis, which policymakers continue to try to keep under control, is not just bleeding into other Chinese sectors now, but also the global economy. And the largest global beneficiaries of China's housing boom will be burnt the worst if the market goes bust. This is an area we will continue to follow closely. Now, while we're on the housing crisis, a quick update to our story a few days ago about property developers in Henan's Zhengzhou, which are merely pretending to restart housing construction because they are unable to actually resume operations. Zhengzhou's local government has announced that the first batch of local relief funds have been handed out to 7 projects, and that the city has received its first batch of the national bailout loans worth 5 billion RMB. However, Caixin, which broke the original story about builders pretending to restart construction, writes that the support still appears to be insufficient to get unfinished homes completed. The financial outlet writes that the project on the top of the list of projects to receive bailout funds, for example, needs 1.6 billion RMB to be completed. The project's developer intends to apply for 515 million yuan in special loans, and Industrial Bank Co Limited, a state-owned bank, could be encouraged to issue an additional 515 million yuan in loans. But the project has only been allotted 387 million yuan in the first batch of national special loans. So even for this first prioritized project, it's unclear whether the developer will receive the funds necessary to finish the project. As we can see, the situation in Zhengzhou is also an ongoing development, which we will continue to follow. Okay, next up, let's look at a more positive area for the Chinese economy. Helped in large part by sustained government stimulus and subsidies, China's largest new energy vehicle manufacturer, BYD Co Limited, reported record sales in September. The new energy vehicle sector is one which we've been following for some time on China Update. In industry, Beijing policymakers are betting big on, hoping to be a leader in an emerging market. We remember that at the end of last month, month, China extended the exemption on a 10% tax for new energy vehicle purchases until the end of 2023. The tax exemptions were originally meant to be ended in 2017. One of the many examples of taxpayer-funded corporate support that once committed, even temporarily, can be difficult to end after implementation. In September, Hong Kong and Shenzhen-listed BYD sold over 201,000 new energy vehicles, a category that includes electric and hybrid vehicles. This is a very respectable 183% increase year-on-year and the 7th consecutive month of growth. In the first half of 2022, BYD's net profit attributable to shareholders surged over 200% year-on-year to 3.6 billion RMB, just over $500 million, much better than the 24.4% decline over the same period last year. The industry generally is doing well too. According to data from the state-backed China Passenger Car Association, in September, sales for all passenger cars rose 23.3% year-on-year, with new energy vehicle sales up over 70%. BYD has been making waves internationally too, enjoying the backing of famous US investor Warren Buffett, though the market generally has mixed views on the Chinese automaker. The company's Hong Kong stock has lost 35% of its value over the past 2 months, though this could largely be due to the general global rout we have seen in stock markets around the world. Buffett's Berkshire Hathaway Inc. also modestly reduced its holdings of BYD by $100 million, a 20.04% share to 18.87%. What we are seeing in the industry generally does seem quite promising, however, but the true health of the industry will not be tested until generous subsidies are removed and the sector players are required to compete in freer market conditions. Now, speaking of stock prices, let's move to our next development. Hey guys, if you like what I'm trying to do here with China Update and you would like to help me keep the channel sustainable, Patreon and Buy Me a Coffee links are in the description below. This is the best way to help me continue providing these episodes every day here on YouTube for you guys. If you enjoyed today's episode in particular, don't forget to hit the like button. Thank you so much everybody, as always, for the ongoing support. Next up, stocks traded in Hong Kong saw their biggest jump since mid-March as the Special Administrative Region reopened after its holiday on Wednesday, hot on the heels of global market rallies in global equities from earlier in the week. The benchmark Hang Seng Index jumped an impressive 6% in trading yesterday, Wednesday. Bloomberg's Hong Kong team writes that the bounce in Hong Kong offers some reprise for investors after losses this year that have been among the worst in the world. We remember that the Hang Seng Index slumped 21% last quarter in its worst performance in more than a decade. Quote, as investors shunned stocks on China's COVID restrictions, frictions between Beijing and Washington, and a property market slump, end quote, according to Bloomberg analysts. Quote, this might just be a short squeeze after a terrible quarter and so many months of bad performance, and there may be some rebalancing heading into this quarter. Volumes are also thin with mainland markets out, which is exacerbating the moves. End quote. Other equity strategists observe that October will be an eventful month with the 20th Party Congress, which will kick off what has historically been the strongest quarter for Chinese stocks. Investors will be hoping for further stimulus in the property sector and, of course, signs from Beijing of easing of its so-called zero-COVID policy. Okay, let's end this part on the economy by examining a piece published yesterday by the Council on Geostrategy by veteran China economist Oxford University's George Magnus. The piece is called The Chinese Economy, Troubled Times Ahead. Here are some of Magnus's observations, which should not be particularly novel sounding to regular China Update viewers. Quote, even though the PRC's zero COVID-19 policies have undoubtedly exacerbated economic stress and will probably be abandoned eventually, the PRC faces strong structural economic headwinds, many of which are systemic features, not easily fixable bugs. These include those arising from an overhang of excessive debt, a bust in the property market which has put almost 30% of annual gross domestic product GDP, at risk of stagnation for many years, and productivity and governance failings. It is a moot point whether the PRC can resolve these problems satisfactorily, partly because the CCP itself is one of the main architects of the economy's current ailments, and partly because of the systemic nature of the problems. Changing the system is simply not an option. The PRC's Leninist lurch forward in politics, Marxist lurch forward on the economy, and nationalist lurch rightwards in foreign policy has resulted in real policy changes. Neither the 20th Party Congress in October nor the National People's Congress next spring are likely to result in a material shift in these policies. Instead, the CCP's agenda is about consolidation and continuity. The PRC's $17 trillion economy, growing at 2 to 3% annually, can still add a lot of GDP, but if that GDP is unstable and unproductive and does not add the quality, high-paying jobs the Chinese economy desperately needs, the PRC's economic status will be adversely affected. This in turn might easily have a bearing on how it is perceived and how it behaves, as well as on the longevity of its leader. Solving China's systemic problems is not a technocratic issue or something that can be addressed by a shift in policy emphasis. Rather, it entails the adoption of tough and sensitive distributional reforms that lie at the heart of the economic and political power model that the CCP enjoys, but which may indeed threaten it. Failure to address them, though, would also have political implications that might not be favourable to the current leadership, or perhaps for the CCP itself." End quote. And finally, adding to what we discussed in yesterday's video, let's quickly touch on Taiwan, as a senior official confirmed yesterday that Taiwan has indeed been stockpiling critical supplies in preparation for a possible mainland Chinese blockade. Speaking to reporters in Taipei yesterday, Taiwan's Vice Minister of the Economy expressed that there is need to keep reasonable stores of important supplies. Quote, "With respect to a possible military conflict, we have made preparations for food and energy and critical supplies, including manufacturing supplies. We have a system, we do an inventory every month. We want to ensure that we have a certain period's worth stockpiled in Taiwan, including food, including critical supplies, minerals, chemicals, and energy, of course." End quote. The energy mix is made up of liquefied natural gas, coal, nuclear power, and renewables. Vice Minister Chen explains that while stockpiling of key supplies has been expanded since the beginning of the pandemic in recent months, due primarily to Beijing's response to the Pelosi visit, Taiwan has greatly expanded these efforts further. Taipei appears to be balancing pragmatic considerations with these policies, however. Quote, "China is our largest trading partner. That is a fact. It is the largest manufacturing factory in the world, and the largest trading country in the world. Also facts. With those facts, I don't see, frankly, in the near term we can completely decouple from China. That's not realistic. So we will continue to see our companies working with their Chinese counterparts for business activities." End quote. Okay, that is today's episode of China Update. Thank you so much, everybody, for watching. I'll see you tomorrow.